We are jumping right into a story of geopolitical maneuvering that, well, it went spectacularly sideways.
He really did.
The scene, and our source material sets this up perfectly, starts in the Oval Office. You have former President Trump announcing these reciprocal tariffs on Canadian food exports.
And the claim was that Canada was, quote, ripping us off for years on dairy.
Exactly. The threat was explicit. He threatened to match Canada's supposed 250% tariffs and bring their food sector, and maybe the whole country, to its knees.
The expected outcome was, a quick Canadian surrender. But the actual outcome was this radical restructuring of the entire North American food trade.
So for you listening, our mission today is to really analyze this extraordinary backfire.
We're going to start by exposing what some call the dairy lie that launched this whole conflict. Then we'll detail Canada's really sophisticated multi-year $12 billion pivot to new global buyers.
And critically, we're going to examine the dangerous and maybe permanent fragility this exposed deep inside American agriculture.
It's a fascinating story.
Okay, let's unpack this. We have to start with that core claim, the one that justified the whole trade war. That Canada charges an egregious 250% tariff on American dairy.
Right.
And that number, 250%, it certainly sounds punitive, it sounds crippling. But if the U.S. dairy industry was truly being crippled, the analysis has to explain why the facts seem to contradict the rhetoric so completely.
Well, what's fascinating here is getting into the mechanism of it. Yes, those high tariffs exist, but they're a border measure, not some kind of daily tax. They only apply if U.S. exports go over a predetermined quota.
A quota that was set in existing trade agreements.
Exactly. And the crucial, often omitted fact is that America wasn't even close to hitting those quotas in any major dairy category.
So wait, the U.S. wasn't even maximizing the zero tariff access it already had?
Not even close.
If they weren't hitting the quota, why was that 250% figure used as such a potent political weapon?
Because it was emotionally resonant, but technically hollow. The International Dairy Foods Association, and they speak for U.S. dairy producers, they provided calculations showing that the average quota fill rate was only 26.72%.
Less than 27%. So that means American exporters could have sent 73% more volume across the border, completely tariff-free, but just weren't.
Precisely. As one trade expert, Al Mussel, put it in one of the sources, in practice, these tariffs are not actually paid by anyone.
Wow.
The real barrier wasn't the tariff rate. It was a complex mix of logistics, different processing standards, and just simple market choice. But by focusing on that giant number, the administration kind of obscured the fact that the U.S. was leaving most of its access on the table.
We should probably pause here because this isn't just about dairy tariffs, is it? It really speaks to a fundamental misunderstanding of trade.
I think so. The sources suggest the administration treated food like it was steel or automobiles, just another commodity.
Where you can just apply pressure, get a concession, and then move on.
And that is the core error the analysis highlights. When you weaponize food, a matter of national survival, you fundamentally change the game. You don't just inflict short-term pain. You force the target to prioritize long-term food security and find reliable alternatives.
And once they establish those new supply chains...
The sources are overwhelming on this point. They don't come back easily, if they ever come back at all.
So let's turn to Canada's position when that threat came down. Their vulnerability was massive. 75% of all their food and beverage exports were going straight to the U.S.
That deep dependency was the exact leverage the threats were designed to exploit.
So how did Canada go from, what must have been simple fear to executing a $12 billion economic defense strategy?
They executed what Farm Credit Canada openly called a radical strategy shift. The goal was to deliberately move $12 billion of Canadian food and beverage exports away from the U.S. market over the next few years.
So it wasn't really about retaliation, it was more about risk mitigation?
It was about decoupling their economic destiny from a neighbor that had just become, completely unpredictable.
$12 billion is a staggering number. What did this plan actually look like on the ground?
It was a three-pronged approach, really smart, designed to be mutually reinforcing. First, they targeted a $2.6 billion shift through increased interprovincial trade.
So getting Canadian provinces to buy from each other instead of from the U.S.?
Right, which sounds simple, but it was historically really complex. Provincial governments often found it cheaper or easier to source from, say, California than from another province.
But the political threat gave them the push they needed to finally coordinate.
It did. And the second prong was leveraging their existing trade infrastructure.
You're talking about their free trade deals.
Correct. Canada already had 15 of them with 51 countries. That's 66% of global GDP through deals like CETA and the CPTPP. But they were underutilized because, well, the U.S. market was easy and right next door.
The strategy forced them to finally take those deals seriously.
It switched their focus from just facilitation to aggressive exploitation of those zero tariff markets they already had access to.
Which brings us to the third prong, going after $9.4 billion in completely new business.
In Europe, Asia, and Latin America.
Yeah.
And what made this strategy so brilliant, according to the planners?
What was it?
The threats didn't create the plan, they just provided the catalyst. Canadian planners have been thinking about diversification for years, but the inertia was enormous. Trump's action created the immediate political will, public support, and financial justification to finally pull the trigger. The timing was everything.
Okay, let's follow that money. The first immediate opportunity was Europe. Canada already had CETA, the big trade deal with the European Union, in place since 2017.
It was there, but there was just no real urgency to use it until the tariffs hit.
But then what happened?
Well, CETA immediately eliminated tariffs on 98% of Canadian goods, but that doesn't guarantee sales. Aggressive Canadian marketing and logistical shifts changed that. For example, some Quebec dairy farms reported their sales to Europe shot up by 34% almost overnight.
And this wasn't just dairy, was it?
Not at all. Canadian pork products immediately found huge new buyers in Germany and Poland, while inland Canadian seafood, think lobster and cold water shrimp, started flowing rapidly to Spain, Portugal, and Italy.
The timing here seems almost perfect because there were other global factors at play.
A massive tailwind, yes. Russia's invasion of Ukraine had completely destabilized Europe's food supply pipelines for things like wheat, corn, potash, vegetable oil.
So European confidence in those long, politically fraught supply chains was shattered.
Exactly. And suddenly Canada, seen as this highly stable democratic supplier, became instantly more attractive. They were a partner committed to reliability.
This meant the pivot became structural before the U.S. could even really process what was happening. Canadian companies weren't signing 6-month contracts.
No, they were signing multi-year supply agreements. That requires investment in new distribution, new quality control, specifically for the EU market. You don't just undo that.
So if Europe was the quick win, the sources say Asia was the long-term fundamental transformation.
Absolutely. East and South Asia, talking India, Indonesia, Vietnam, they're projected to account for over 31% of global food consumption growth in the next decade.
That's where the game is being won.
And Canada leveraged their existing framework there too. The Comprehensive and Progressive Agreement for Trans-Pacific Partnership, or CPTPP.
Right.
That deal gave them preferential access to Japan, Vietnam, and 6 other countries, so 500 million consumers. They used that access to immediately displace American competitors. Yeah. Canadian wheat exports to Indonesia jumped dramatically.
Canola too, I read.
Canola, a crucial Canadian crop, flooded into Asian markets, and the sources all emphasize this. Exports jumped by double digits in multiple categories in just a few months.
But here's the key question. Why were these deals seen as permanent? If the U.S. lowered its tariffs, why wouldn't buyers just switch back to the cheaper American option?
Because the key differentiator was no longer price, it was reliability. Canadian negotiators had a powerful new selling point.
Which was?
We honor our commitments, we're a stable partner, and we won't threaten you with tariffs because our president is having a bad day. America's transactional, unpredictable approach meant companies couldn't plan. Canada offered multi-decade stability, guaranteed by treaty, not by political whim.
Okay, so while Canada was busy locking in these new billion-dollar global partnerships, we have to look at what the sources call a silent catastrophe unfolding back in the U.S.
It's stark. Canada is normally the second largest destination for U.S. agricultural products. It's about a $28 billion a year market.
And that market access started shrinking immediately.
Immediately.
Yeah.
U.S. agricultural exports to Canada were down 10% in the first 7 months, and that decline was accelerating. The cruelest irony, though, hit in dairy and beef.
The very sectors the threats were supposedly designed to protect.
The administration started a trade war over tariffs that, as we said, weren't even being paid. And the result was Canadian buyers just stopped buying American dairy and pivoted to new, reliable European suppliers.
And this ripple effect spread.
It went all through the food processing industry. American beef producers faced a devastating loss of contracts. Canadian meat packers, suddenly wary of U.S. political instability, moved away from their reliable American cattle suppliers, and signed long-term deals with producers in Brazil, Australia, and Argentina.
And switching a beef supply chain isn't simple, is it?
It's a complex, multi-million-dollar decision. It involves logistics, quality assurance. Once you make that investment, you don't reverse it lightly.
We see the same pattern, maybe even more clearly in the lumber industry. Trump claimed the U.S. could easily do without Canadian lumber.
But industry experts were setting up flares, providing clear warnings. The U.S. simply lacked the industrial capacity. Domestic mills have been shrinking for decades. They didn't have the drying capacity, the specific equipment, or the sheer volume needed to replace Canadian imports overnight.
So instead of U.S. mills benefiting,
Canadian lumber companies just signed long-term supply agreements with Asian construction giants in China, Japan, and South Korea, locking the U.S. out of future growth in those regions.
and we can't forget about input costs, the threat to put a 25% tariff on potash.
Which is just unbelievable. Canada is America's largest supplier of potash, the key ingredient in fertilizer.
So that decision was literally threatening to increase costs for the very American farmers they claim to be protecting.
It was. The sources describe this intense political infighting. Agriculture Secretary Brooke Rollins had to personally intervene and argue desperately for the administration to reduce that proposed tariff from 25% down to 10%. She was citing the extreme harm it would do to the Farm Belt.
That one detail just shows how little strategic thought went into the downstream impact. And of course, U.S. farmers faced a double blow. They lost the Canadian market and, at the same time, had to deal with Chinese retaliatory tariffs on corn and soybeans.
They were getting hit from both sides by the very strategy that was supposed to help them.
This all led to a fundamental psychological shift inside Canada.
It did. Beyond just government strategy, these Buy Canadian campaigns took hold, driven by new anxieties over food security. Consumer polls showed 68% of Canadians were consciously avoiding American products.
And that number was even higher among younger people.
Among those under 40, it was nearly 80%.
And that domestic movement fed directly into the structural permanence of this whole pivot through a concept called import substitution.
Exactly. Import substitution just means instead of importing goods, you build up your domestic capacity to replace them. Canadian farmers expanded production, processing facilities retooled, often at significant cost, to serve domestic and international customers who they now viewed as stable.
So, to make it concrete for you listening, if a Canadian pork processor switched from using U.S. corn to a new long-term supply of Brazilian corn, and they validated the quality and invested in the specific logistics for that new supplier.
They are not switching back just because a tariff threat disappears.
Right. Switching back would mean abandoning all those new investments, breaking new long-term contracts, and risking relationships that have now been proven to work.
The analysis is clear, the change is fixed. Canada fundamentally became the beneficiary of U.S. unpredictability.
Their exporters then adopted this new, really powerful message around the world.
Reliability. Their pitch was, and it remains, that they offer a stable trade environment guaranteed by treaties and political consensus. It's a direct contrast to the political volatility coming from the South, and that message translated directly into billions of dollars in new business.
Business that American farmers are now losing every single year.
That's right.
We have to ground these huge economic shifts in the human reality. The sources describe a profound human cost.
It's a localized, and it's a devastating cost. It's the Wisconsin dairy farmer whose income dropped 40% when their Canadian buyers switched to Europe permanently. It's the Iowa corn farmer watching futures prices collapse. It's the Montana rancher who lost decades-long reliable buyers to cheaper Australian and Argentine beef.
And the analysis notes the difficult reality here, that this economic damage disproportionately hit the very agricultural regions whose political support was leveraged to start the conflict in the first place.
They bore the majority of the cost, while the intended political gains, they never materialized.
The damage isn't temporary, it's structural. Canada is on track to achieve its goal of moving its economy away from American agricultural dependence.
And doubling non-U.S. food exports within a decade.
So what does all this mean for the bigger picture? What's the core lesson about food and power that this deep dive reveals?
The lesson, I think, is that food is power, but it's the power of resilience, not leverage. When you weaponize food, even against an ally, you force that country to put food security above everything else, above economic efficiency, above price.
And once security becomes the priority, reliability matters more than anything.
Canada built alternatives. They invested in that resilience, and the U.S. lost vital, high-value market access permanently.
And this dynamic is being watched globally. Other countries saw the U.S. do this to its closest ally and are now, quietly, diversifying their own suppliers to reduce their dependence on American agriculture.
Essentially, the administration was teaching the world exactly how to survive and even thrive without American agriculture. And that's a lesson. Once it's learned and structurally implemented, that doesn't get unlearned.
So the empty warehouses in Iowa, the ones once stocked and waiting for those reliable Canadian orders that will never return, that, according to this analysis, is the true structural legacy of the U.S.-Canada food trade war. It's a profound thought to take away from this deep dive.